Statistics New Zealand released trade data for the March quarter yesterday. This data splits out export receipts into volumes and prices over the quarter. It showed that export prices increased 6.3% over the March quarter, which was stronger than we had expected. Surging global commodity prices underpin much of the increase. But in addition, the relative softness in the New Zealand dollar over the quarter also helped provide some boost. Typically, when we see global commodity prices increase quite strongly, the New Zealand dollar also follows, providing some natural buffer. However, over the Q1, the New Zealand dollar was weighed by the earthquake in February and the 50 basis point cut by the OCR. As a result, the relatively soft New Zealand dollar helped provide an additional support to commodity prices. The increase in export prices was led by a 5% increase in dairy prices and a 10% increase in meat prices. Furthermore, we see scope for commodity prices to increase further over the June quarter. In particular, given that a lot of agricultural product is sold on forward contract, it can take up to 3 months for higher spot prices to be realised in export receipts. Given the strength in spot markets over the first quarter, we expect much of this increase to also flow through into the second quarter. Further reinforcing our view that dairy prices will remain firm for much of this year, the global dairy trade auction last night showed a further increase in dairy prices. They increased 4.5% on the last auction result. The increase is particularly impressive given the pressure that hard commodity prices have been under over recent weeks given global growth concerns. Economic data out overnight showed that manufacturing confidence fell right around the globe during May. Manufacturing confidence in China fell to 9-month lows, while confidence in Europe fell to 7-month lows, and manufacturing confidence in the United States fell to the lowest level in almost 2 years. Some of this decline does represent supply disruptions, particularly as Japan production has been disrupted as a result of power shortages following the earthquake. The broad-based decline around the globe does highlight how interconnected the global economy has become. As a result, the loss of momentum in manufacturing activity is concerning as it poses significant risk to momentum in the global recovery. Meanwhile, employment data out in the US suggests that job growth possibly stalled over May. This suggests some downside risk for US non-farm payrolls, which is released this weekend and is closely watched by the markets. The combination of weaker manufacturing data and weaker employment data weighed on equity markets overnight. The loss of risk appetite also weighed on the Kiwi dollar, which saw the New Zealand dollar fall below 82 cents against the US dollar overnight. The focus of Australasian markets yesterday was on the Australian GDP for Q1. Q1 GDP contracted 1.2%, which was slightly weaker than the market's expectation of 1.1%. However, there were fears that the contraction could have been even worse, and as a result, the Australian dollar lifted in relief following the result. The 1.2% contraction does sound much worse than it actually is. It reflects temporary disruption to exports as the Australian economy was hit by a string of natural disasters over a quarter. Partial monthly data since then has shown exports have recovered quite strongly. As a result, the contraction is expected to be temporary and the Australian economy will continue to recover strongly over the rest of the year. Indeed, looking through the report, it does show quite strong demand continues in the household sector and business investment. As a result, the Reserve Bank of Australia needs to look through this weak quarterly result and concentrate on rising inflation pressures as a result of strong underlying demand that remains in the Australian economy.